3, 2, 1. Welcome to the show.
Welcome to the show.
What's up, Jerry? How's
what happened
Boston?
What happened to our little ditty?
I don't know.
What happened to our little
Facebook doesn't like it anyway.
That's true. Facebook doesn't like it.
Yeah. What's up, man?
Yeah. So, dude, all good.
Back in Boston, whole.
Yep. Back up here at the previously undisclosed location, but now everybody knows. Hull, Mass.
Nobody knows.
Fantastic place. Nobody knows what that is. No. But if you're flying over from the south up to Boston and you look out the window on your left-hand side, if you're flying over the water, going north, you look out your port side, you'll see I'll be waving to you. We're, probably not the Speedos, but yeah. Good. It's a good place to hang out for the summer. I can tell you that.
Crazy week, man. What's going on? Tell us what's going on in the market.
We're going to work through a bunch of things before we get to what actually is going on in the market, just because people have been asking. But I am kind of excited to get to what's going on in the market. So let's go to what we're going to be talking about. All right. So we had some people asking on Facebook, hey, if we have a 300 million, billion, whatever amount of deficit, how can that not have an effect on the market? And basically that led me to this idea of, hey, let's talk about some of the macro factors that affect the market. I mean, that's most of the stuff that I watch on YouTube, and it's pretty interesting because basically people fall into two camps, at least that I follow. Either you follow macro information and try to make decisions about how you're going to manage your TSP based on macro factors in the economy, or you look at charts and you make decisions based on what the chart's doing. And right now, those are going in two opposite directions. So the newsletter is actually about that this weekend. So if you get the newsletter, you definitely want to check it out. So we're going to talk about macro factors. And then a separate question on Facebook, actually, it's been all over the group, is people having problems making what used to be called an IFT, or a change of fund allocation. And so I went through as much as I could without actually doing it in my own account, but I went through it and I did some screenshots, and we're going to take a look and see kind of what I think is the best way to use either the change investment mix or move money between funds. And then we'll get into the TSP fund charts. Okay. So macro factors, kind of how they matter and how they don't, right? We're going to just take a look at debt versus deficit, inflation, interest rates, and the war in Ukraine, because those are probably certainly within the top most important things that people are talking about to affect the market going forward. So when they talk about debt, right, public debt is the amount of money that we owe, right, that the government owes, and it can owe it to its citizens, right? If you buy treasury bonds as a citizen of the United States, the government is indebted to you, right? It can also be other governments that buy treasury bonds. The U.S. government is indebted to other countries. So debt is what we owe. Deficit is the difference between the amount of money that we take in taxes and the amount of money that we spend, right? So two completely different things. But obviously, if you spend more than you take in, it increases your debt, right? Which is why, make sure my pen is on here. Okay, so a couple of things to point out on this chart, right? The reason that the line is trending up is because our deficit, right, the amount that we're adding to the debt every year, is increasing, okay? So it's interesting back here that, so this is in actual dollars, right? So we have about a $30 trillion debt right now. But it's in actual dollars, right? It's not on a percentage basis, it's in actual dollars. So this is a little bit deceiving down here, because while it looks like our debt was basically zero on a percentage basis, right? The difference between 1975 and 1980, it doesn't look like it went up very much, but on a percentage basis, that's a huge move. Okay. But in the long-term chart of this, the thing that's interesting is we had this breakout in 1982, right? That really started this bull market. And it started as we started increasing our deficit. And then it really kicked up after 2009 when QE started going and we really started increasing the deficit. This kind of goes along with the bull market that we've been in. So the more we spend that we don't have, the more the stock market goes up. It's unbelievable, but it also goes to the idea of how long can that last? I mean, I don't know how long it can last, but it started back here seriously in 1982, and seemingly the more we increase, I mean, here was COVID, right? We borrowed way more than what we took in, and the debt increased, right? And the stock market exploded higher. So as I was putting this stuff together, I thought that was really interesting. How high can the debt go? I have no idea. Deficit. So it's the same kind of thing, except this is a chart of the deficit. So all the way back here to 1910, we basically had a balanced budget, right? We had very few times where we spent more than we took in until, again, 1982 or so. And then ever since then, other than this one section up here in the late 90s, we had a balance, we had a little bit of a surplus. But basically, ever since the early 1980s, we've spent more than we've taken in. And this was the amount of money that we spent here. That was COVID, right? So we put out way more than we took in. And that's the deficit. So how long can we have a negative deficit like that? I mean, who knows? It's obviously extreme compared to all the way back in history to 1910. And nobody knows the answer to that question. It's what generates a lot of the fear mongering, a lot of hand wringing, and people are like, there's no way we're ever going to pay this back, and that the market's going to have to crash because of it and all that. And it may, but there's no way to know when that might happen. So that's debt and deficit. Definitely two things to understand, because when the media talks about it, they say the deficit is X. They almost never talk about sometimes they talk about the debt, but you definitely have to understand when they say we're balancing the budget, all that means is the deficit is not gonna add to the debt that we already have. It doesn't mean that the debt is balanced. I mean, we're 30 trillion in debt. That's not going anywhere.
Right. Isn't that like, it's the difference between like cash flow in a business and the debt you have, right? The loans that you have outstanding, right?
Yep, 100%.
And so your cash flow is your in and out, right? Your income and your outgoing. That's the deficit. We could still just be it's the same. Trillions in debt and the deficit is balanced, right?
Right. If you're living on your credit cards, and you get a raise, let's say, and now you don't need to live on your credit cards anymore, that's great. The credit card debt is still there.
Right. And just because you stopped adding to it.
Yeah, you stopped adding to the debt. That's all.
Yeah.
Right. And the big thing for us, as a country, is that we owe, we have 30 trillion in debt, right? The interest that we have to pay is the rate of the treasury bonds. And there are different levels of, treasury bonds. So let's just say on average, they're 5%, right? Mm-hmm. If we have to pay 5% interest on those bonds, then if the interest rate is low, it's no problem, because there's a difference there that's in our favor. If the interest rate is high, meaning if you borrow money to pay on the debt, which is what we do, the debt service, we borrow that money. If we have to borrow that money at the current interest rate of 9% to pay back the 5% interest, that 4% gets added to the deficit.
Right.
You know what I mean? That's why it's bad for your family when credit card rates go up, because you got to pay more and you don't have it.
Right.
How long can it go?
We could do a whole show just on deficit and debt.
Yeah, but the bottom line to the question I think on Facebook was that does it matter? It probably matters at some point, and I don't want to get into the whole modern monetary theory and all that, but the U.S. is the reserve currency, at least at the moment.
For now.
For now, yeah. I mean, that is a whole show in and of itself. But as for right now, the dollar is the reserve currency, and we have figured out, it's fiat, and we can just print more money. Whether or not that's inflationary is another whole show. But we print money to pay back the debt, the service on the debt. And so as long as we're able to continue printing it, because the dollar is, it's no longer a silver certificate, or it's not backed by gold. It's backed by the full faith and credit of the United States government. So as long as everybody still has full faith in the credit of the United States government, we are good to go. Once that changes, which you see it, you will see it when it happens in the bond market, because people will demand a higher rate of return because they don't trust the full faith and credit of the U.S. government anymore, and that's when everything will start to unravel. When that happens, who knows? People have been talking about it since 1985, when this thing first started. It first started really printing money. So, right, that's that is the debt and deficit. So the next big one is inflation, right? Everybody's talking about inflation. Yes, we had this monster spike in inflation in the 70s and early 80s. Since then, the inflation rate has been relatively stable, right? If that's the average, that's about, I don't know, say 3%, right? The problem right now is we are up here at 9%. Okay, is where we are right now. Obviously, this only goes through 2020. So we're way up here at 9%. And how long can we continue to have to borrow at that rate? So as the Fed pushes rates up, it knows that the bonds, they're in a trick bag. We've been talking about it on the show. Everybody talks about it on the media now. The Fed is in a trick bag because it's trying to bring inflation down, but at the same time, and it does that by raising interest rates. But at the same time, when it raises interest rates, it knows that it's costing the U.S. more to service its debt. So it's a wicked trick bag. Inflation is a problem for us individually, because if inflation is up here at 9%, credit card rates go up, mortgage rates go up, all that goes up. And the concern now is that with the Fed raising rates, it makes it more expensive for companies to keep employees and reinvest and all that. And so it creates demand destruction, so creates unemployment, and that ultimately will enable the Fed to bring rates back down. But it is quite a game that they're trying to play. So inflation is definitely a big deal, and it's one of the top ones that everybody's talking about. And again, it's way outside the average that we've been since the end of this whole big inflation problem we had the last time. Okay. The next one is this idea of interest rates, and I know you hear it all the time. The difference between the 10-year rate and the 2-year rate, when they say the yield curve inverted. Okay, so when the yield curve inverts, it means it's below the zero line. All right, it doesn't happen very often, and the reason everybody points it out is because whenever the yield curve inverts, it's a precursor to a recession, right? So the gray is recessionary periods, and every time the yield curve inverts, we get a recession. Okay. The thing is, we've been in this negative yield for quite a while here in 2021, end of 2021 and into 2022. It's actually much further down now than it looks on this chart, because we're only going out to end of 2020. So we're down here somewhere. You can kind of tell by looking back. It doesn't really matter as long as the 10-2 is inverted. As long as it's negative, that's fine. It's when it starts coming back up that the economy starts crashing, right? So the inversion is an indicator that recession's coming, but when it comes back up is when recession is starting. Can you see that on the graph? Does that make sense?
I can.
Okay. Yeah, because I just want to make the distinction, because everybody talks about the inversion of the yield curve, and yes, it's telling you that recession is probably coming, but it's definitely not here yet. When this flips in the other direction, is when you really have to worry about it, because then the recession's like right on the doorstep. Okay. All right. So when you hear about that, the inverted yield curve, if you follow it and or hear about it on TV, when the yield curve goes the other way, that's the time to get worried. All right. And the last one is war in Ukraine, right? So I took this from it was a Federal Reserve article. They call it Fed Notes. It was from the end of May. So basically, it's saying geopolitical risks have soared since Russia's invasion of the Ukraine, right? And nothing has really changed. You know, the world's economic outlook is grim. Europe has huge food and energy problems right now. Obviously, they're very worried about going into the winter, because if Russia doesn't sell Europe energy, then Europe is going to have a very tough winter, which should push prices of oil back up. Oil has come off quite a bit, and it should start to push prices back up as they have to figure out another place to buy natural gas and oil going into the winter. So our main result suggests that rise in geopolitical risks seen since Russian invasion of Ukraine will have a non-negligible. So I guess that's a significant macroeconomic effects in 2022, right? So you can read all that if you want. The bottom line, increased geopolitical risks induced by Russian invasion of Ukraine will weigh adversely on global economic conditions throughout 2022. I think everybody probably understands that, but to hear it succinctly from the Fed should kind of raise some flags. Such effects are estimated in our model to reduce GDP and boost inflation significantly, exacerbating the policy trade-offs facing central banks around the world. It's the trick bag that the Fed is in. And it's not just the Fed, it's all central banks around the world. So while sizable, these effects do not appear to be large enough to derail the global recovery from the pandemic. That's optimistic. We'll see if that holds out to be true. However, the future of the war is highly uncertain, and unforeseen developments in the conflict could generate further changes to geopolitical risk and worsen its economic effects. Okay. So those are all macro things that affect the economy, and we'll see it eventually. Usually you see it in the stock market before the actual risk becomes a problem, because they say the stock market is a forward-looking instrument. And so that's why people read the macro stuff and anticipate that the stock market is going to do things based on that. And it's usually the other way around, which is why right now everybody's trying to understand from a macro perspective, how can we be in this rally since June? It doesn't make sense with all this bad news. You know, inflation is higher than it's been since the 70s. You get the war in Ukraine going on. You know that they're going to need food and energy going into the winter. It just makes no sense from a macro perspective why the stock market is going up. And so if you're stuck in making reallocation decisions based on macro indicators, you're going to miss the moves. You might feel better about that you understand why things work, but it doesn't really matter. What matters is what the price is actually doing. And we're going to get to that after this one other section. Okay. So a lot of people talking about they don't understand, and I agree, the new system is in virtually every way much worse than the old TSP site. But you go to the new TSP site. You log in, and this is the screen you get, right? So what we're talking about is change investments. Okay, all this other stuff is definitely useful, but in terms of reallocating your funds, we're talking about change investments. Okay, so you hit that change investments button, and it takes you to change investments. So you get three options. Okay, we're not going to talk about the mutual fund window today, right? We've talked about it in some other shows. I'm sure we'll talk about it some more, but right now we're not going to talk about mutual fund window. These are the two: change your investment mix and move money between the funds that you can use to make reallocations in your accounts. Okay. So if you look at example of change your investment mix, right? If you hit that example tab, this is what you get, okay? So you decide how your current balance and or your future contributions are invested based on the percentages you enter, okay? That and or is the whole thing. So if you go to change investments, in that tab, you can do both your current balance and your future contributions. So you can do, it'll walk you through both what used to be an IFT and what used to be a change of fund allocation in the same kind of process. Okay. So again, this is the example, right? If your current percentage was distributed this way and you make the changes, now your new percentages are distributed that way. Okay. Just like an IFT used to be, or a change of fund allocation. Okay. If you go to the other one, right, the move money between funds, I don't really know why anybody would want to do this. The functionality is the same as it would be kind of in a brokerage account. I just don't know why you would want to do it. So you can move actual dollar amounts. So the example is there. It's a little bit convoluted. You can, Jane has balances distributed, so you got $100 in B, 400 in C, 500 in D for a total of 1,000, right? And then if you want to move your money around, you can do that. And this is what you would get. It'll tell you where you moved from, where you moved to, what your new balance is, where the new money is going. But I just don't really understand why you would use that tool, I guess is what I'm saying. So those are what the examples say, okay? So if we're back to the change investment screen, I hit that change investment, so I'm hitting get started, okay? And this is what I would do. If I was gonna make a reallocation in my account, this is what I would do. Hit the get started button, and this is what you get. It says, what investment mix do you want to change? So your options are money that's already in the plan, which is an IFT, right? Or only money that'll be contributed in the future, which is a change of fund allocation. So from this perspective, it's exactly what we used to have, okay? The difference is if you stick with the first bubble, right? It's your new mix will be applied to future balance in a later step. Right? In a later step, you'll be able to apply your future contributions as well. So this is the bubble that enables you to do either an IFT or both an IFT and a change of fund allocation. This bubble is only a change of fund allocation. Does that make sense?
I think so. Right. I mean, I think like when we send out an alert, right?
Yep.
You would go to that initial screen, right? And then you click.
We're going to this screen.
Yeah, you click change my investment mix. Boom.
Yep.
And you click the top one on the next screen, and that will allow you to make both changes.
Yes. And so this is what it looks like when you hit it. Okay. So, and it's gonna walk you through. So it's actually pretty good. It gives you a lot of good information. So you hit that screen and it tells you to choose your fund mix. So this is the mix that I have right now. This is the new mix, right? Because I haven't done it yet. It tells you how much. So some funds aren't included in this mix. Why? Because those are the funds that are in the mutual fund window. Okay. So it gives you a lot of good information in there. You definitely want to, let's see, you basically follow it along. So let's see if I can track this right. So it tells you, as you scroll down, it gives you the funds that you're in, the funds these are the funds I'm in. These are the percentages that I'm in, the total percent, right? The amount of money you have in there. And then it tells you, this is the effective date. If you complete the change by noon Eastern time on, in this case, it was August 18th, right? So this is another thing that people have a hard time with. What that means is the effective date, okay? it means when the market closes on August 18th, whatever the price is at the close that day is the price that you're going to get when you do the change of fund allocation or the transfer. Okay. So if the C fund was $100 on the 18th, and at 11 a.m. East Coast time, you do a reallocation to say, okay, I want to move from the C fund to the G fund. At the end of the day on the 18th, if the C fund had lost 1% of its value, that's the amount. So now the C fund went from being worth $100 a share to $99 a share. When you transfer over, it's the value of $99 a share, right? It takes effect at the end of the closing day. Hopefully that makes sense. Okay, but that's what you would do. So you tell it, you put the new amounts in there, you hit continue, and then it tells you which funds you move the money to, right? Amount to move. You can do it either in terms of dollars or percent, and that's as far as I went because I didn't want to do a move on the 18th. So hopefully this gives you guys a little bit, at least, of an idea of how the thing works. Again, there's a ton of good information in here, and it keeps telling you the effective date of the move. It's that day's closing price, and it also does say, and I think it was on the first slide, that you need to check the parameters because you only get 2 moves a month, and it's trying to remind you that make sure you want to make that move because you only get 2 moves a month.
Nice.
Does that make sense?
Yeah. I mean, I think it's probably more instruction than they have on the site.
Yeah, I mean, it was much more straightforward and simple on the last site.
I wish they would have, put some kind of article on there that says, "Hey, this is what we used to call it, and this is what it is now." Right? And they didn't do any of that. You're supposed to figure it out.
Yeah. I mean, I wouldn't mess with the change money button. I don't see the value in it personally. Maybe there are people out there that think it's useful. I just don't see it.
Yeah.
And for me, since I'm not contributing anymore, I don't do a change of fund allocation.
Yeah, your future money. Yeah. And I think that's what people have to kind of think of it as, is the money that I have in my account now and the money I'm going to put in it in the future. Those are the 2 buckets, right?
Yep.
Or two
buckets.
They're not. Yeah. For us, it's the same bucket because we always put future money into the same place. Yeah.
Right. So we can talk about that for a second. So if there are different strategies, right? You can say that if the market's going down, I want to contribute into the stock funds because I'm buying shares cheaper. It's a dollar cost averaging kind of mentality, and you can definitely do that. You can make an argument for it. It makes sense. Or you can say, well, if the market's going down, I'm going to buy the G fund because it's not going down. And then when the market turns, I have more in value in my account that I can distribute into the stock funds that will grow faster because I had more in there. So
and that's more in line.
I don't want to get into that whole. Yeah, that's our methodology. So there are people that, absolutely dollar cost averaging is the way to go. And it's certainly a tried and true kind of methodology. I just don't think it's the way to maximize your growth at the end of the day. All right. So TSP fund charts. All right. So I pushed out this chart, a similar chart this week on Facebook, right? The chart that it wasn't a chart. I think it was a video actually. This guy did a video on the 100-week moving average, and the picture on the video, I think, kind of grabbed some attention, which is good because it basically said "you are here," and it showed, I think it was 2008, and it said "you are here," and a lot of people see that, and they think the implication is that the market's going to go down, right? Because if you look at this, how else could you take that? If you say you are here, the implication is that the market goes down, I think. The other side of that, though, is it's the same thing. You are here, right? It doesn't have to go down. It can find support, right? And go back up. So what I'm saying is don't let the pictures kind of, derail you. The video was really good. He used a 100-week moving average, and we usually use the 200-day or the 200-week. In this chart, I used 150-week. The moving averages don't mean anything. There's nothing particularly, important about a 50-day, a 10-day. What you're trying to find is a moving average that most aligns with where you're going to find support and resistance. So in this case, the 150-week moving average shows really clear, I think, on this chart back to 2007. We had support, right, at that 150-week moving average. Then it hit resistance, and then it rolled over, right? Once it got back above it, it hit it. I would call this resistance, right? Because it rolled back down, again, got back above it and stayed there, right? Once it gets above it, it found support all the way along for a long time until COVID, which was an overshoot, okay? But for, since the middle of 2010, all the way until 2020, it found support every time it hit that 150-week moving average, okay? COVID was an overshoot. That's fine. And then the bottom that we had in June is right on that 150-week moving average line. RSI is above 50, right? So, it's awful hard to bet against this chart because, minus this COVID overshoot, once we get above that 150-week moving average, we find support there and move higher. The only time that didn't really happen, it's hard to see in terms of price here, but in 2016. So the other part of this chart that kind of complements it is the relative strength. Okay, so we hit a low in relative strength right here, right? The market comes up, market's going up. Relative strength comes up, comes back down a little bit, tests that 30 line again, and then takes off. Okay. So once we hit a low, we stay above this 50 line. We basically get support at this 50 line all the way along, right? What I'm basically trying to get you is this section right here. We hit this low, we came up and got above the 50 line and then rolled back down. Okay. So every other time we hit the low, we move higher. We hit the low, we move higher, hit the low, move higher, right? That's generally what happens. This is a little bit unique. Okay. See if I can zoom in on that one. Okay, you can see there in the middle of 2015, we basically hit that zero line, came up, got above the 50 line, and then rolled back over and almost got down to the zero line again. Okay, that's pretty unique. That hasn't happened anywhere else on this chart. And so the concern right now is that we came down, hit that zero line, now we're back above 50, and it rolls over and comes back down again. It's only happened once since 2007. It could happen again, right? We could definitely come down. We could either test this line and move higher, or we could test this line and move lower. But that's what everybody's kind of looking at right now is, do we get something like a 2008 where we have a break in that moving average line? We came up here, we got a little bit above, right, which was this point right here. We got a little bit above 50 and it rolled over to new lows and price kept going lower, right? That's possibility number one, let's say. Possibility number 2 is we get something like what happened in 16. We came down, ultimately got support there, and price moved higher. So it appears that that's what's happening right now, right? We came down, got support, and price has been moving higher since June. So in the big picture, in the big scheme of things, this is a very bullish looking chart. We hit support there at that 150 line, bounced off it, and had a super strong move higher. So it's awful tough right now to bet against that move higher. Okay. At least that's how I would read it. If price rolled over and closed below this trend line, now you're in a completely different place, right? Now you're much more something like this. But we don't know. We're not there yet. And the market's moving up until it's not. All right. So that's a very big picture look at it. So now we're back to the 3-year weekly charts that we always look at. This is the bottom from COVID. Again, once we got above that 20-week moving average line, we got support all the way along until January when we closed below it. Okay. So that was the first indication that something significantly different is happening. We had this first wave down, right? We had a recovery, got back above that line, but it couldn't hold, rolled right back over. Now we're in the second kind of bear market rally, right? Could it roll over and come down and go to new lows? Absolutely, that could happen. And if you just looked at the recent history, we came up, we had a couple of weeks above it and rolled over. And it looks like the same thing could be happening right now. And it could. That's true. RSI looks like it's above 50, but it looks like it's turning back down. And it could definitely roll over. Are there examples of times when it didn't? If you look at this one right here, we got above, we had a big move higher, not too much different from this one. Big move higher here that confirmed that we were definitely above that 20-week moving average line. And then the very next week, we had a huge down week, right? And then we consolidated for 3 weeks along that moving average line and ultimately moved higher, right? Same thing happened here. We got support, had several weeks of moved higher and a huge week down that took out all these prior 4 weeks of gains, but we got support at that line, right? So what I'm saying is, just because this looks like this does not mean it's going to turn out that way. It could definitely be something like this, or it could also be this. We just don't know yet. That's why the 20-week moving average line is so important. It's why it's important to get in as soon as it gets above that line, and equally important to get out as soon as it gets below that line. Okay. S fund, the idea is the same. It's just that we had a much bigger move down this week. This week basically took out all the gains from last week, and we are just barely above that 20-week moving average line. Do we get support there and price continues higher? It's certainly possible. RSI is at 49.59. It's right on that 50 line. So next week, it will probably be pretty telling for the S fund. And if we can get any indication, the I fund is definitely, this is a great chart. It's not what we want to see, but it's a great chart. Every time price tried to get back above that 20-week moving average line, since the beginning of the year, couldn't do it. And it couldn't do it this time either. So the I fund certainly appears to be rolling over. It hit just below that 50 RSI line and is rolling over. I fund does not look like the place you want to be right now. F fund, even more dramatic, right? We put in a low here in June, had a pretty good rally, got above that 20-week moving average line, but this week here that we just completed, a big move down. And a lot of that has to do with, because I think the market is finally getting the point that the Fed is not going to slow down in raising interest rates. And so as interest rates go up, price goes down. And I think the bond market has kind of come around to the idea that the Fed's not kidding and they're going to keep raising rates. As they keep raising rates, the F fund price will keep going down. So that's what I think will happen. The C fund, let me just go back to that real quick. The C fund is still, on a percentage basis, pretty high above that 20-week moving average line. So if you were going to wait until it broke below it, you're going to absorb those losses, right? Given that the S fund is just barely above it, you could get support. You don't know. I fund rolled over and F fund rolled over. Kind of take that all together for what it's worth, but there's an awful lot of risk that we go lower from here at this point, I would say. Okay.
Questions. If you have any questions.
A lot of stuff in there.
There's a whole lot of stuff.
I don't have any questions.
Well, if you, the viewer, have any questions, you can put them in the comment section wherever you find the video. And if there's not a comment section, well, then just shoot us an email at support@growmytsp.com. We've been getting a lot of questions lately, though, that are very specific and personal to your circumstances, more like, give me financial advice. And, just a heads up, we won't give you financial advice over in a YouTube comment section. So if it's a general question, we're happy to answer it.
Yep.
All right,
if you want to know what we're doing, on a day-to-day basis, because I was actually talking to a guy this morning. We go over the 3-year weekly charts on the show, and the long-term view, obviously the one that we did from back to 2007 is a very long-term view, and it's much more bullish than the weekly view, and it's a whole lot more bullish than the daily view. At some point, you have to make a decision. Right. So what we do for our subscribers is tell them what we're doing on the day that we do it. So if you want that kind of level of analysis and information, just hit us up at growmytsp.com.
Cool. We don't have any cool music to go out on, but if you like the video, please share it with your friends. If you don't like it, share it with your friends. All right, guys, have a great week, and we will see you later.
Out of here.